Can you see my screen?
Yes, we can see it.
Okay. Start out with disclaimer. We are a private investment group. We do not offer tax advice. You should obviously you speak to your tax advisor about any investments that you are making. MAGCP Capital Partners, who are we? We are a private commercial real estate investment group. We focus on single-tenant net lease industrial, and that's what I will go through with you as our particular strategy. We were started in 2015. Our principals, Dax Mitchell and Andrew G, got together. Dax comes from the commercial brokerage side. Andrew comes from the commercial appraisal side. Again, got together in 2015, started investing in medical office buildings. Transitioned pretty quickly to industrial, realizing that industrial is a really great asset class. And since then, we have grown to $1 billion in assets under management. We have $150 million in realized investment exits, and we're exiting at about 18.1% over the course of all of our investments to date. Within our group, we have a team of about 25. We have in-house acquisitions, in-house credit, in-house a construction manager, in-house facilities management. So we do everything in-house, full service accounting and everything. So we are a full service team. This is us. We've grown a bit since this picture, so we need to update it. We're all getting together pretty soon, and we will have a new picture of the whole group. But we have experienced principals, an institutional credit team that come from large industrial REITs, so they are very skilled at looking at the credit of industrial tenants specifically. We have, demonstrated deal sourcing. We have a very good track record that I will review with you. Currently, we are at about $10 million square feet under management, and we are operating about 31 states. You can see where we are kind of in this map. Typically, what you're going to see with industrial is, Texas up the Midwest and over the Rust Belt. So you can see the kind of that L that veers off to the right. And that's typically what you're going to see. But we do have some outliers. We have a lobster processing facility in Maine, and a couple other outlier properties. We are in real estate, direct investments. We have a private equity arm within our group that every once in a while have a private equity investments. Those are really interesting single asset deals we can offer. We have some institutional joint ventures, and our fund model is typically what we're focusing on. The fund will be consistently offered, along with some single asset deals will be sprinkled all throughout. So industrial, why industrial and why now? So industrial, we believe, is a stable asset class. I feel that we're going to show you that the facts around industrial is it's a consistently performing asset class. And when we talk about industrial, we talk about industrial being four walls and a roof, right? You see buildings on the side of the freeway, or new buildings that are being built, or any other industrial buildings, and really anything can happen within that building. They're typically going to be built out for the business itself, but again, it's four walls and a roof. Anything can be any business can be inside that that is manufacturing. What we found is that onshoring, reshoring has pushed industrial. Especially post-COVID, a lot of businesses realized that they needed to bring their goods closer. I live in Southern California. I saw all of the boats parked outside, in the ocean. So, the need for domestic logistics and manufacturing to bring their goods closer was ever present during and post-COVID. We are looking at second generation industrial real estate. So we're not looking at new builds or new construction. And there is space demand that's outstripping constrained supply into the foreseeable future. Our acquisition cap rates remain higher than capital costs. We're finding really great real estate with great cap rates. I can talk to you about some of those cap rates as I go through the fund model, both fund 1, 2, and 3. And we have opportunity to acquire quality assets below replacement cost. We try to maintain about 150 to 200 basis points between the spread of our cap rates and the fixed rate debt that we're placing on the properties. There is a very active lending environment. We are have no shortage of properties that we are looking at and that we're determining. We are currently in the middle of acquiring for Industrial Fund 3, and we have some really great real estate that I can talk to you about. And the fund itself is a securitized cash flow yield, and I'll go through that in a second. So MAC Industrial Fund 3, like I said, we are focusing on single tenant net lease industrial. What does that mean? Single tenant means that we have a single property that has an owner that has built their business in that location. They are maybe not mom and pop, maybe they're family owned. They've been in business, let's say 30 to 50 years. They're very established in their market and have some sort of hold in whatever it is that they're doing in terms of, let's say, aerospace, cold storage, manufacturing, distribution. We are looking at these properties and placing a long-term lease, and that's an absolute triple net lease, which I'll go over in detail in a second. But the target highlights for the MAGCP Industrial Fund 3, 6-year hold. We are raising $250 million. Exit multiple is 1.95 times. And the target hold cash on cash during the hold period is 6 to 8%. I'll caveat that by saying that we have some different levels that I can discuss with you about your group. But we have an 8 to 10% preferred return, 14 to 16% projected net IRR, 55 to 65% average fund LTV, quarterly distributions, and I have 2 options for investing, a direct and a REIT option that I'll go through with you. Our strategies, this is our 3rd fund. We had Fund 1 and Fund 2. Fund 1 opened and closed in 2022. We opened Fund 1 in June 2022. It was a very much anticipated fund. We ended up closing to investors in August 2022. We closed the fund up completely with all the properties acquired in December 2022, and that was Fund 1. Fund 2, we opened in February 2023. We are in the process currently right now of closing. We've already closed to investors. We are closing on the last 2 properties, and we are refinancing 2 properties that we have closed in all cash. So that fund is completely closed up and stabilizing. Fund 3, we are opening with 3 properties that I will review with you. And our strategy is current cash flow from fully occupied single tenant net lease industrial. So the seller becomes our tenant. We're placing a long-term lease. It's a 15 to 20-year lease at least. Those are absolute triple net leases, meaning that the tenant pays for everything. They pay for the maintenance, upkeep, taxes, the building itself, and the land around it. So we have a fully performing tenant from day one, and we have no expenses, and that is our strategy. We perform in-depth tenant credit analysis. Our credit team is looking very, very deeply at the credit of these tenants, making sure that they are currently successful and that their trajectory, their future is only going to grow stronger. Because really what happens when we sell is that we want to make sure that the tenant is still in space, that the tenant is more successful, and the real estate itself is then more profitable upon exit. We perform physical and environmental assessments. So our construction manager on staff goes and visits all the properties, determines any work that needs to be done on these properties. Let's say that they need a new roof. We will make sure that the roof is completed. But really, these businesses are focused on making sure that their place of business stays very well maintained. But we obviously want to make sure that there's certain improvements that are done through the course of our hold, so that when we do sell, again, the property itself is more profitable. So we will make sure, again, let's say a roof needs to be done or redone, then we make sure that that's completed in a timely manner. We have stabilized rental trends at or below market. So we don't try to stress our tenants. We place rents that are realistic, and then go up from there above market rents. And then we'll place a 2 to 3% rent bump on that each year, which then is written into their financial plan. And we focus on real estate basis at or below replacement cost or near vacant value. We capture flow through depreciation, so I can talk to you about that as well. We have two investment options, the REIT and the direct route, which I'll talk to you about in a second. But the direct route will offer depreciation. So that is a benefit for investors. The tax strategies, obviously, is why people invest in passive investments. We also have, diversification from the fund. You have multiple properties versus a single property. So your investment is diversified. We have, a fixed cost compared with the single asset investments. Inflation right now is obviously a topic of interest, but this investment is a hedge against inflation. We have hard assets, which is, real estate, and that is the greatest hinge against inflation, right? Our net lease structure shields against inflationary increases like expenses, including taxes, insurance, utilities, and building and maintenance costs. These are all written into the lease. So they're expected, and they are, not for us to pay, it's for the tenant to pay. The 2 to 3% rent escalations that we have are built into leases. So again, the tenants will write this into their finance plans for the whole entire hold period, which then drives predictable NOI growth and an income stream for our investors. We are putting debt on these properties, each one individually. And the current interest rates we see are trending downward from the most recent peaks. We have long-term fixed rate debt that we are putting on the properties. And we also have debt from a combination of lenders. So we are typically going to, banks that are centered around where these properties are located. We can, get different types of regional banks, national banks, securitized bonds, financing, a lot of different funding options that will be best for each property. The industrial market itself, we see it only getting better over time. So industrial real estate, this is more looking at new builds, really, to be honest. But completions grew in 2023. They've dropped a bit with new construction decreasing. The absorption remained positive over the last 18 months. Current U.S. industrial vacancy rates are about 6%, with manufacturing at about 3%. And industrial assets continue to appreciate nationwide. And as you can see from these three charts, industrial demand and vacancy and asking rent is just going up. The industrial space is trending in a great direction. As well, here you can see another chart that shows private manufacturing construction spending in the United States. You have the blue, which is the real private manufacturing construction spending, and then in the dark lines, you can see the annualized percentage change. And really, what we're looking at is an overall increase again in the industrial market and seeing industrial thriving.
Hey, Amanda.
Yep.
William just asked, what's the difference between industrial and commercial real estate?
Great question. So there's a lot of different types of commercial real estate, right? Industrial is one asset class. And what we're doing, we're even like driving down a deeper. We are looking specifically at US manufacturing. Deeper dive, we are only looking at single tenant net lease. So single tenants, we're not looking at multi-tenant. So that's, a different type of industrial. We're not looking at new build or new construction. We're not trying to tenant up a building. We are only investing in industrial real estate that has a tenant in place that will stay in place for the life of the investment. So we're not, filling spaces. We're not, the cap rates that we're finding for the single tenant is really fantastic. And I can show you the cap rates in a second. I think there's another slide that goes through the cap rates that we're looking at. But when we're looking at the industrial real estate right now, what we're finding is that we're finding really great properties in secondary markets, more or less.
And Glenn is asking, what's your target purchase value?
That's interesting. It's actually per property. We are our industrial fund two. We're raising more money than we did in fund one and fund two. So the starting real estate prices, which I have the last three slides, show the three properties that I have in industrial fund three. But around, let's say 20 million or so, maybe less for industrial fund one and two. But we are looking at some really great real estate. The real estate we have for fund three has multiple locations, which, like I said, I'll show you all the very detailed specifics about those at the end of the presentation.
Okay. Glenn just amended his question a little bit here to say percentage of value. I assume that means how much of a discount are they buying it to market value? Is that what you're asking, Glenn? Okay.
Is that
Okay. Yeah, he's asking about that question.
say that again?
He's asking what sort of percentage are you trying to buy, or what sort of discount are you looking for to market value? That might be on a case by case basis, but
It is,
that's
yeah,
the
it is on
question.
a case basis, but I do have some details about the properties. So
Let's go for it.
if I don't get to that, re-ask that question, and then. But
Okay.
I have some
And then
details.
and then later on, I want to ask you questions about who your target tenants are.
Yes, please
You
do.
might have that in your presentation too.
I do. That's what it'll go through and show three target tenants that we have right now, and I can talk to you about some past tenants that we have as well in fund one and fund two.
Okay.
This slide just shows more about the industrial market. It shows leasing volume growth. You can see the light blue is auto parts and tires. The dark blue is manufacturing. Orange is energy and utilities. All of these are trending up, especially in terms of the auto parts and tires. But what we're seeing here is that leasing demand continues to grow across manufacturing sectors, and that's where we are, right? We're putting long-term leases on these properties. Supply remains tight for manufacturing companies. So the businesses that we are, the real estate that we're acquiring from these businesses, they are not wanting to go elsewhere, right? They're not motivated to go elsewhere. The building itself is built around their business. They've been in there for a significant period of time. All these companies have at least been in their properties for more than 10 years. That's the very, very minimum. A majority of them much longer. So they have, no desire to go elsewhere. And if they even wanted to, right, the leasing volume, there's tight supply. So, it prevents them from being able to secure their own facilities in a different location, and kind of moving elsewhere. And what you're seeing here on the right-hand side is the U.S. manufacturing submarket by region. So you have the orange and national, you have the light blue, Midwest, Northwest, South and West, and you can see that these are trending down in terms of vacancy. So our sale-leaseback strategy, why would somebody sell their real estate to us, right? That's the question we get all the time. And the reason is twofold. So we have a benefit for us, there's a benefit for the seller, and I'll start with the benefit for the seller. Why would they sell to us? What this transaction is an alternate form of corporate financing. So they are selling their real estate. They don't necessarily need to own the real estate for the business, right? But they want to take out the dormant capital from their real estate, reapply it back into their business to grow. And that is, a part of the contract that they're signing, is that they are, reapplying capital back to their business to grow. When they're redeploying capital, they're doing a few different things, and it really is per company. They can expand, they can have a debt retirement, they can have some capital improvements. There's a number of things, but all in all, what they're doing is reinvesting capital back into their business to grow. If they go to a bank, a traditional bank, and put another loan on their property, they're not gonna. They'll get maybe 70%. If they come to us, they'll get 100% of the capital back from their real estate to grow. For us, it provides a stabilized income-producing commercial property. So we are not looking, like I said, at finding new tenants for these properties. We are adding new long-term leases. There's a couple different ways that we acquire these properties, which I'll go through in a second, either by brokers or private equity groups. But what we're putting on is a 15 to 20 year lease with annual rent escalations and quarterly and annual tenant financial reporting, and that's important as well. So, these tenants become our partners of sorts. We want to make sure that they continue to grow, that they stay successful. So we stay with the credit of the tenants. They have to submit to us quarterly financials. We also make sure that they are, growing sufficiently, that we're doing everything we can as a partner to make sure that happens. And we can look at some other types of ways to grow. And that's another slide that is after this one. This right here kind of shows what we look at, for the last 12 months. We looked at about 4,000 new investment property opportunities. We submitted 500 LOIs, 400 credit reviews, 200 management meetings, and then that ended up being 30 to 50 deals closed. So we do a lot of, we have a great amount of deal flow, but we are very conservative. We're very specific about the properties that we acquire, and that is through that credit team who looks very deeply at the credit of the tenants to make sure that they are hitting these certain benchmarks that they need them to hit in order to invest. We acquire these properties from broker relationships, could be from private equity firms. So private equity firms will sometimes acquire these properties. They will then place their own leases on the properties, but their business model is not to own real estate, so they'll sell us the real estate. We also have some off-market deals versus M&A executions. We have, private relationships with REITs, and so we've kind of deal sourced from a variety of different places. We've established ourselves as having a great track record in single-tenant net lease industrial. So we do have people that come to us directly to offer us these types of deals, knowing that we are able to close on these properties.
Hey, Amanda.
Yeah.
I'd like to give you a little piece of active feedback.
Yes.
I'm getting quite a few comments that you are using the word a lot, like
Oh, I'm so sorry.
almost every sentence. I just wanted to make you aware of that.
Okay, thank you. I appreciate
We,
it. Yes,
yeah.
I will watch that. I will also now go over our value add strategies. So unlike a multifamily property, we have some value add that we can add to these properties, but it's not going to be a traditional value add like you would see again with a multifamily where you're adding and you're building and you're doing. Ours is going to be more tenant expansions and development should the business expand or need to expand any further. So we can look at some capital improvements. We could look at some value add investment profiles. We can look at some GP-led maintenance projects for tenants. Our in-house facilities management, construction manager, general contractor, we can do all that in-house. We can also look at some lease renegotiations. We have additional value that we can capture through lease engineering, extending lease terms, converting leases to absolute triple net structure, and that's our strategy. Smooth rent escalations to predictable annual intervals. So we can do a lot of different things to add value over time, in addition to the traditional, organic growth. We also have some risk mitigation. Our tenant, the overall tenant credit is what we are mainly focused on. We want to evaluate the tenant's long-term financial profile, and that's what our credit team looks into when we are assessing the deals. We look at the overall financial health, the tenant access to capital, and we want to avoid highly vulnerable companies. So our credit team, like I said, looks very deeply into the credit of these tenants, make sure that their trajectory is only growing. We also look at unit level financials for all target properties, make sure that it's profitable location, make sure that it is tenant investment into properties. And then ultimately we have defensible real estate. So real estate is acquired below replacement cost. We limit the downside scenarios for bankruptcy, liquidation, lease rejection, and we purchase near value property when it becomes vacant. Acquisition criteria. Yes.
Oh, let me know when you want to take a couple of questions. We have a few that have built up.
Okay,
But
I can
continue if you'd like.
I can take one now and then move on.
Sure, I'll just start in chronological order here. Glenn is asking, are you finding your deals primarily from manufactured owned RE or from PE firms that are offloading their RE elements?
Both. It really both. We
Hmm.
we get deals from brokers who will come to us directly. We also have private equity groups that come to us directly with properties that they've acquired. So we really have both, honestly. I have three actually, some uh, examples of properties that we have that shows private equity groups, what they've done and how we've acquired them.
Okay, and I'll do just one more question here. MM is asking, what are the stipulations around tenants breaking lease? Have you ever had a tenant do this and not follow through on the terms of the lease?
That's a very good question, and we have that question all the time. So a majority of what we are investing in here is making sure that these tenants are going to stay long term, and that really is essentially what you're investing in, and that's what our due diligence is. Let's say that something happens and the tenant has to vacate the property. We had only one really that was not. I wouldn't even say that it was a situation that was a fail because it ended up being a great situation, but it was unfortunate. We had a tenant who was in the aerospace industry who post COVID received faulty parts. And as a result, there was an unfortunate helicopter accident and resulted in death. What ended up happening is that the company had to claim bankruptcy. We then were able to get the property out of bankruptcy, and we were able to then sell the property and return to investors a double-digit return. So, although it was one of our single asset investments, with your fund, you're diversified, so you have a lot more properties. But with this property in particular, it was an unfortunate situation that ended up being okay. The returns weren't as high as we anticipated for investors, but it still was a double-digit return. So with that real estate, it still is the a benefit. It still is what we have as a strong basis.
I'll throw one more question in there because I think this one is a good one and probably quickly answered. Ashish is asking, how long is your typical hold? What motivates you to dispossess an asset?
Yes. So that is what actually I will go through in particular for this fund. It's a 6-year hold, and I have a chart that shows what happens at each level at each year of that investment. I'll kind of get there a little quicker now. So that this is you had asked Daniel about our properties and some of the different properties that are different, areas that we invest.
Uh-huh. Yep.
But the property types that we have is, industrial manufacturing, distribution, cold storage, food production, aerospace. It's any types of U.S. manufacturing, more or less. We are looking at only domestic United States, only single tenant net lease industrial. The gross revenue of the tenants is 50 million at least. They have to have EBITDA margins of over 8. Actually, it's debt to EBITDA is under 5x, but typically the EBITDA margin is typically over 10, to be honest. We are looking at the lease structure, and I've already gone through kind of what that is, but the absolute triple net structure, the 10 to 20-year lease terms, the 2 to 3% annual rent escalations. We are investing for this fund into 30 to 50 property investments, $10 to $50 million per investment. And again, the total fund size, so I'll go through in a second. Debt, we are looking at fixed interest rate, including rate cap and swaps. We have 5 to 10-year loan terms, 55 to 65% loan to value. We have a blend of 25-year amortization, 30-year amortization, and interest only. We reduce and eliminate prepayment penalties whenever possible. We have regional banks typically around the property. We have national banks, community banks, life insurance company lenders, and we have single asset loans and credit facilities with pre-committed debt capital. Projected life cycle, and this kind of goes back and answers that question. So what happens over the life of the hold? So we have year 0 to 1. That's our roll up and acquisition. We are raising 250 million of equity, and that will be 500 to 700 million of leveraged assets with immediate distributions. We have years 1 to 5. This is where we have the compounding and management. We have escalating cash flow from leases, so that's where the distributions come from. We have debt principal pay down, value add opportunities. And then years 5 and 6, this is where we're looking at the sale and return of capital and profits. So we have exit the properties. There's a couple different ways that we'll exit, and I'll go through that in a second. We have individual portfolio sales, and we have manager discretion on market timing. So this is what more or less what the 6 years looks like. This is another chart that shows what that 6 years looks like. So we're looking at year 1 where we're rolling up, where we have acquisitions. Year 2, 3, 4, 5, we're looking at the rent distributions. And then year 6, then we're looking at that rent distribution, the property sale, and the profit split. And then it all goes up to that 1.95x. Exit strategies, and this answers that questions about exits. We have a couple different ways we can exit this. We can sell each property individually, or we could sell the full package, let's say to a public REIT or to an institutional group. So we have a couple different, opportunities that we can look at. That will be determined as the fund progresses. But we have throughout the life of the holds, we have rent and NOI escalations, debt principal reduction, cap rate compression, time to market exits. So all of these things are kind of happening on the backside. This is the overview of the Fund 3. We have 2 different investment opportunities, the direct and the REIT. I will go through these in more detail and what those look like. Raising $250 million. The fund term, it says 5 years from final acquisition. So we're looking at 6 years. We're looking at that 1 year, year 1 to be the acquisition year, and then the 5 years after that. We also have 3 optional 1-year extension options just in case it isn't a great time to sell. We have this open to accredited investors, and we are also open to IRAs, LLCs, trusts. We have an overseas corporate blocker. So if you or anybody that you know is investing from overseas, we have that for this one. The investment waterfall is return of capital first, then preferred return, then GP catch up, and then the GP LP promote waterfall. And I'll go through what that looks like specifically. We have 8 to 10% preferred return, begins accruing the first day of the month following funding. And then we have the promote, which again, I'll go through with you specifically what that looks like. Our acquisition fees are listed. Management fees will vary depending on your investment level. Our target debt is 50 to 70% LTV with fixed rate debt and selective use of interest only, swaps, and rate locks. We are investing through the direct and the REIT. Again, I will go through that in a second and what that looks like specifically. We will call capital no more than 120 days, but as a group, then we will have you all come in at one time. We have quarterly distributions. In those quarterly distributions, we always have a distribution report. So we will report everything that's happening within the fund. And we are very open to questions and open to information. We also each quarter have a webinar that we will then allow you access to our principals to ask specific questions directly to them. Our principals co-invest 5 to 5 million equity on 250 million equity raised, so 2% GP co-invest. With carve-out guarantees provided by the principals Dax Mitchell, Andrew G, and Neil Walgren. We have fund support, so outside fund support. We have a fund auditor outside. We also have fund management for both the REIT and the direct. So this right here is what I was talking about prior. We have 4 investment levels, and this is where you as a group are incentivized to come in and work up to these higher levels. So we have A1 is any investment under $250,000. The management fee is 2%, and the preferred return will be 8% with a 75-25 split. A2, 250 to $1 million. 9%, 80-20, A3, $1 million to 5, 9%, 80-20, and then 5 million and up, you get the 10-20. But Here is where we are incentivizing our investors. We are giving you a bump in your levels. So what that means is if your group comes in anywhere between, let's say, 250 and a million, we'll bump you up to this next higher A3 level. If your group comes in over $1 million, we'll bump you up to A4, where you all will get 10%, 80, 20, and a 1.5% management fee. So as a group, you are working together to be able to be bumped up to this next level. And that can happen over time as well. So, if you come in initially at a certain level, we will allow you to continue to grow that and work into those next higher categories. And I will, allow you to continue to work towards that A4 level as a group. And I talked originally about the direct versus the REIT feeder fund. These are two different ways to invest. The direct will offer accelerated depreciation. We say a minimum investment of $250,000. And the reason being is because with this fund being larger, we will have at least, let's say, 14 states. So I have to be very open with the amount of K1s that you potentially could get with that direct investment. You have identical cash distributions between the REIT and the direct. Your income type for the direct is rental. You have pass-through depreciation, so you get the benefit of that accelerated depreciation on all the properties closed within the year of your investment. You do have UBTI, you have the federal K1s, the tax forms, and this you can invest, individually, LLC, corporation trusts, to utilize that pass-through depreciation. The REIT on the other side is another opportunity to invest, but you will not necessarily get all the K1s. You'll have a singular K1 with no states. You are blocked. The UBTI is blocked. You have dividend income for that, and your distributions are identically the same for the direct and the REIT. It really is for tax purposes. You can invest through your IRA, 401k, and this. It is, for LPs that are sensitive to heavy state tax return filings and requirements. So this is a lot of investors who don't want those multiple K1s, but still want to get the tax benefits. These typically will be seen on the back end. And I do have a document as well. We have a tax document that I can send you all individually. So if you want me to send that to you, I'm more than happy to send that document that goes through this more in depth and more in detail. Are there any questions on this?
Yeah, I was going to comment from at least the club fund's perspective. The fund would be receiving those. And
Yes.
then our club fund, at least my CPA has let me know that we can provide a consolidated K1, but of course it depends on his advice in this area. But the multiple funds, multiple K1s would be coming to the club fund.
Okay. Yeah. And that's what we always say. We're not tax advisors. We always say, speak to your tax advisor and figure out,
Right.
obviously, what works best for you individually or you as a group.
Pavi do you mind if I throw a few questions in here?
Please. Yes.
Specifically, since Pavi's got a question on the direct investment structure,
Okay.
and he's asking, how can you invest this way? Is it through sole ownership, joint ventures, syndication? What's the structure that's surrounding direct investment?
You can invest through this individually through LLC, trust, corporation. It really is a tax strategy for anybody that wants to receive the the accelerated depreciation from the properties. We write off anything inside of the properties that is useful, that will allow us to write off. It's almost as if you're owning industrial real estate yourself. So you're writing off any of the materials inside the property that goes with the property. So we depreciate those each individually for each property, and then pass that through to investors. So you're able to invest really anyway through this. If you're investing through your IRA, obviously that would be through the REIT or your 401k. Those would be through that REIT feeder fund. But if you're investing directly, then that would be that direct investment for the tax purposes.
And then Pavi is also asking, How are rental incomes and expenses allocated amongst the investors? And what is the management fees associated?
So that's the management fees right here. So depending on the level of your investment, that's the management fee right here. So 2% for A1, 1.9 for A2, 1.75 for A3, and 1.5 for A4. Those are the management fees. For a gas again with the
Oh, how are incomes and expenses allocated amongst the investors in the fund?
so income and expenses, it's a your distributions come from the uh, the rent bumps, right? We do have the management fee, and then we have, if I go back, the acquisitions fee, which is relatively low. I think it was 1.5. So we do have those fees in there that all kind of blends together. But these are the management fees that are for each level individually, and we've reduced those at higher levels.
Yeah. And Anita is asking, are the distribution returns of capital or return on invested capital? And I suppose, yeah, go ahead.
Yeah, so it is what we do is your first investments, your first distributions will be return of capital. Then we have the preferred return is secondary, and that's different for this fund than we have for the other funds. So for this fund in particular, we're return of capital first, then we have the preferred return, and then we have those exit waterfall splits.
Okay, and let's see. Ashish is asking, approximately what percentage of your capital raised comes from individuals and clubs versus RIAs, broker dealers, or institutional investors?
That's a very good question. Very good question. We have built our business on individual investors and on groups like yours. So that is a majority of our focus and a majority of our strategy. This fund, obviously raising now up to $250 million, we are developing relationships with institutional groups, family offices, RIAs, and we'll see what percentage that is. That's a new strategy for us. We have previously only worked with individual investors and private groups such as yours up until this moment in time.
Uh, Prolette is asking, return of, not on capital? Does that mean that all distributions reduce your investments?
Good question. Let me get back to you on that one.
Yeah.
That's a good question let me get back to you on that one. That
Glenn's
would be a
asking,
great opportunity for me to follow up.
yeah. Um, Glenn is asking, given you have a single tenant and fixed triple net leases with 15 to 20-year time horizons, what's your main reason for exiting within 5 to 6 years with a consistent cash flow of 2 to 3%?
What we see is that the investment itself, when and I do have another chart that I can send you all that is not actually in this presentation, but typically what we see is that within that time frame of the 4 to 5 years, it becomes timely to exit in terms of the investment itself, right? So the investment in terms of the drop off and the amount that we're going to be able to gain versus selling and being able to return a profit split to investors, that timeline becomes about 4 to 5 years. So it becomes timely for us to exit at 6 years. As well, we want to be able to sell these properties with a significant amount of time left on the lease. So if we're signing a 15 to 20-year lease, let's say we sign it at 20 years, right? And we sell at year 6, then we still have 14 years left on that lease. And the property itself is still very valuable with a significant amount of time left on the lease. And if we go under that, if we go under 10 years, then that property maybe is not as interesting to buyers. So really, we want to make sure we have the most amount of terms on the lease to be able to sell to other investors who will then continue that lease.
All right. And the last question that I have currently is the management fee the only fee that is associated with the fund?
No, we have the acquisitions fee too. I can go back. Let me see. Right here. So we have acquisitions fee is 1.25% of the purchase price of the real estate.
Okay. And I see no disposition fee, so no fee on selling,
Nope.
uh,
And
property
no property
management.
management fee. And this is because the properties themselves, the businesses are managing themselves. So we have no
Yeah.
property management fee as well.
Benefit of the triple net lease.
Correct. Correct. Yes. Yes.
All right. MM is asking who is the typical buyer after a 6-year exit? I think we addressed that a little bit earlier, but you can recap it again.
Yeah, yeah, I'll say again. So typically what we're looking at for an exit is going to be either individually selling each property, and that buyer can be really anybody, right? It's typically not going to be the business itself. They're not going to buy their real estate back. It'll typically be, somebody else who wants to acquire real estate, a group. Um, we also have some private equity groups that we could sell to. We could sell to industrial REITs. They are, a target for us to sell. They typically don't want to build these packages, but they want to be able to acquire packages that are already performing. So that's a strategy as well. So there's a lot of different ways that we can look at it, and there's a lot of different exit strategies that we're anticipating. So it'll be a determination at the time of what will allow us to return the most amount of the waterfall to investors.
All right. I don't have any other questions as of right now. Um, I guess let me say I'm going to drop into the chat the link if you are interested in being contacted about putting money into the club fund and pooling it together to put into MAGCP's industrial fund. Go ahead and fill out the form. It's not an obligation. It's just a request to be followed up with. And Amanda, do you have anything more that you want to present here, or should we wait for questions?
Yeah, let me show real fast a couple of the properties that we have for Fund 3. I think it's
Yeah,
interesting to show. These
just
are some.
just to let you know too, we've got 6 minutes left in our
Yep,
meeting.
I will. Yes, I will do this quick. I'll stop here. This is my contact information. If you would like to receive our offering memorandum directly, if you would like to receive that tax, the direct versus the REIT, I can send those to you. This is my email address and my phone number. So please make a note of that. And then this is our pipeline right here. And this is really interesting to look at if you're interested in these first three properties that we will be closing on. We have Produce Packaging, which is based out of Ohio. We have White Plain Linen out of New York. And we have Robbins Sports, which has multiple locations. We are actually not closing in September. We pushed those out. So we're closing more October into November. The price of each of these properties. So we had some questions about price. So each of these is, at or around $20 million. And we have cap rates of about 7.8 to 8.1%. Fund one, I mentioned the cap rates earlier. The fund one, we typically were looking at 6.5 to 8 cap. Fund two, we had really fantastic cap rates. We're looking at 8.5, 9 cap. And now fund three, we continue that really great trend of having amazing cap rates for industrial real estate. This is the interest rates that we were getting these properties at right here. So we try to stay within that 1.5, 200 basis points. And these are the loan to value for the terms. And we have fixed rate debt for each of these. And this is just a little bit Produce Packaging. They are a packaging company as a tomato repackager. This is all, the transaction summary, the details on that one. 2 locations in Ohio. And this is a long-term lease. We believe this is a really strong tenant. This right here is how we look at the properties. So revenue, the EBITDA margins. We said that it needs to be at least over 8. This one's 8.8, 21. So we're looking at great real estate. White Plain Linen is a uniform supply company and a cleaning company. They're based out of New York. They are a fantastic company with really great revenue looking forward. And this again is transaction summary. This is a straight leaseback in a really strong area. And then lastly, we have Robin Sports. Robin Sports has many locations in Ohio, in Michigan, and Wisconsin. We have acquired all the locations from them. They are a leading manufacturing distributor of premium sports flooring products. So this is a really great tenant as well. And they have a really great cap rate for this one. It was that 8.1%. Any questions before we are ending?
Glenn threw a question in there. What is your pro forma cap rate exit expectations for the fund?
Yeah, so it depends per property, to be honest. So we look per property. It depends on where we started with the cap rate and where we can end up being. So let's say, 6. It just really depends per property.
Okay. All right. I don't have any other questions at the moment. So could we have everybody take themselves off of mute and thank Amanda for coming in and speaking to us today?
Yeah, thank you, Amanda.
Thank you,
Thank you,
Amanda.
Amanda.
Thank you.
Amanda.
Thank
Thank you, Amanda.
Thank you.
And I'm sorry about all my ums at the beginning. It's my I'm nervous. My nervous.
You improved
habit.
quite a bit when I mentioned it, so
When
good
I
for
think
you.
about it, I know, and it points out to me, then I think about it. But
You did a great job. Thank you.
thank you so much. Yes, and I look forward to speaking to you. If you all have questions, please feel free to ask me any questions that you have. I will also get you an answer to the question of or on for the distributions.
Okay. And if you are interested in investing through the club fund, the link is in the chat. Feel free to check it out. I hope everybody has a wonderful weekend, and we will see you all back here next Friday.
I hope you get better.
Yep, I'll be better by next Friday.
Thank you so much.
Thank you, Glenn, for offering to MC. Maybe I should have taken you up on that.
Hey, Daniel,
I'm like shivering from fever right now.
Yeah,
So
you need to definitely go get some
I'm
sleep
gonna.
and lay
I've
down.
got one more meeting today, and then I'm gonna take a nap.
Hey, by the way, I'm getting pings for some people on Teams that they're hunting for a couple of links, one to the fund and the other one to your site. If you want to just drop them down at the bottom, I know you've got them in there somewhere. But
I will do you. Let me see if I could do you a little bit better. I'm gonna send everybody here the link to my staging site, so the beta site of the upcoming fund, and I've got more information about it here. So I'm aware that we need a good fund landing page. We do have one with NAV Consulting, but if you're interested in being on the beta testing site for the upcoming webpage, it's here. I'd love to get your feedback on this as well. It is still really rough, and so I've got a bit of work to do before this is completely public. But here is our site, and it actually goes through the first. This is the fourth investment that this club fund is making. So the first one was in a debt fund, which gives us liquidity and which and the cash flow. Second one was with business equity into SaaS. Third one was with the prefabricated modular construction, which has got an innovative business model and good cash flowing returns. And then now that we have the lower liquidity funds in place and the cash flow established, the industrial funds are longer term holds with better IRRs. So we'll be mixing in the cash flow and the heavy investments with the IRR or more growth oriented investments in order to build a fund that is both cash flowing and growth oriented and passing through depreciation. So here's the beta test site. Feel free to send me any feedback. I'm aware of a lot of things that need to be fixed, but I'm happy to have you there. I'll
get
talk
some
to you
rest and
all
feel
later.
better.
What's that?
Get some rest and feel better.
Yeah, will do. Stay on for just a few more minutes for anybody who wants links. All right. Grab those links, and in 10 seconds, I'm going to be shutting down the meeting.